What are the most powerful wealth building tools that require little technical skill? And how do our brains hold us back from a more prosperous future? In The Psychology of Money, investor and finance journalist Morgan Housel answers these questions and shares how human thought, habits, and emotions are intertwined with investment. He shares insights and strategies for how investors can leverage these connections for personal gain, not only financial, but also personal and emotional as well. Real quick, for those of you who don't know us, we analyze business frameworks and summarize business books to stay on top of the latest business strategies. Before we get to the insights, Morgan Housel is a partner at the Collaborative Fund and a former columnist at the Wall Street Journal and the Motley. His work has been focused on the exploration of how investors deal with risk and how to handle it in a more productive way.
I think there's a really powerful kind of logical idea that investors are playing the same game, that we're all investing in the stock market. We're often buying the exact same stocks. So therefore, we're doing the same thing. And I think nothing could be further from the truth.
When it comes to how psychology impacts how investors view money, it's important to understand how personal experience impacts their worldview. Personal experience makes up 100 millionth of a percent of what happens, but 80% of how people think the world works. In theory, financial decisions should be driven by an investor's goal and the characteristics of investment options available to them. Economists from the National Bureau of Economic Research found that instead, investment decisions are anchored by early adulthood experiences. They found that investors tend to weigh more heavily the experience of the economy when they were young than what the economy is like now. Both luck and risk are often the factors that determine success and failure. Because they are hard to measure, they are often discounted. Some of Bill Gates' success can be attributed to hard work and good decisions. However, some of it can also be attributed to the fact that he went to a high school with a computer. This was roughly a 1 in 1 million chance in the 60s. To account for risk and luck in decisions, an investor should 1. Avoid idolization of specific investors when it cannot be known how much luck or risk influence their success. And 2. Focus less on specific individuals and case studies and more on broad patterns. For example, the key to good investing is not to earn the highest returns. It's to earn pretty good returns consistently. The powerful nature of compounding interest is counterintuitive, but is the backbone of investment. Warren Buffett has managed to achieve an average annual return of 22% throughout his career. On the other hand, Jane Simmons of Renaissance Technologies has achieved an incredible 66% per year. Yet, Buffett is 75% wealthier than Simmons because he's invested for 40 years prior to Simmons. Believe it or not, more than 97% of Warren Buffett's wealth has been accumulated after the age of 65. Most investments either fail or break even. The vast majority of your success is determined by a small number of big winners, tail events. In the Russell 3000 index, 40% of companies lost at least 75% of their value. Effectively, all of the index's returns were driven by only 7% of companies that outperformed the average by at least 2 standard deviations. Those big winners are the ones that create value. In 2018, Amazon single-handedly drove 6% of the S&P 500's returns, and Apple drove another 7%. If you owned an S&P 500 index in that year, almost 1/7 of your returns came from just 2 companies. If the number 1 rule of investing is compounding returns, then the number 2 rule has to be that tail events create the returns that get compounded. In VC investing, approximately 65% of companies lose money. 2.5% of companies return 10 to 20 times their investment, and 1% of companies return over 20 times their investment. Lastly, 0.5% of companies are able to return 50 times their VC's investment. The majority of VC returns come from that last category. To allow enough time to take advantage of tail events, 1. Don't panic in a crisis and sell prematurely. 2. Be a consistent investor. And 3. Take advantage of a wide range of investments. In the 1970s, it appeared that the world was going to run out of oil. The rate of oil consumption was increasing faster than the rate of oil production, but those predictions did not account for the new efficiency technology would create. The US now uses 65% less energy per dollar GDP than in 1950. Saving is like that oil. It is easier and more effective to use the already available wealth more efficiently than to find new sources of wealth. From 2002 to 2018, Netflix returned 35,000%, but the price of success for someone invested in Netflix through that time was high. Netflix traded below its previous all-time high on 94% of days during that period. Similarly, Monster Beverage returned 319,000 from 1995 to 2018, but traded below its previous all-time high on 95% of all days. Investors have three options. They can either A, accept this volatility as the price of the returns, B, accept lower returns with less volatility, or C, try to game the system and get these returns without the volatility. In 2008, GE, one of the biggest companies in the world, almost collapsed. Their stock price went from $40 in 2007 to only $7 by 2018. One of the problems was that they were under their CEO, Jack Welch. Their extremely lucrative financing decision would always beat Wall Street estimates. They'd always return higher no matter what. They gamed the system, massaged numbers, pulled returns from future quarters to current quarters. But that caught up with them. And when the stock market collapsed, so did their game. Most investors who try to game the system see it come back to bite them. Morningstar studied 112 tactical mutual funds from 2010 to 2011, which tried to beat market returns and compared them to simple 60-40 stock-bond mutual funds. They found that with few exceptions, tactical funds gained less, were more volatile, and were subject to just as much downside risk. Volatility, loss, uncertainty, and doubt are natural parts of investing. They have to be accepted because they will always appear, and to think they can be avoided often just exacerbates the effects. Investors have to accept that sometimes they will make a loss and not get out of it because of that. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors shifts from mostly long-term to primarily short-term. From 2000 to 2004, the number of homes sold more than once in 12 months that were flipped rose from 20,000 to 100,000 per quarter. This, in turn, drove up the price of homes. Similarly, in the late 90s, day traders, to whom the cost of a stock was largely irrelevant as long as it went up in a day, drove up the price of most stocks. Cisco rose 300% in 1999, and Yahoo rose to 500 in the same year. Bubbles, however, do their damage when long-term investors start taking their cues from short-term investors. In 1999, the average mutual fund had a 120% annual turnover, meaning that long-term investors were not investing for the long term. Different investors have different goals, and one of the biggest financial mistakes that can be made is to take advice or cues from investors who have different goals from you. Getting wealthy and staying wealthy are two completely different skills. Getting wealthy requires risks and being optimistic. Staying wealthy requires caution and paranoia. 40% of companies successful enough to become publicly traded lose all of their value over time. The Forbes 400 list has on average a 20% turnover rate per decade. Here's a unique example. The Battle of Stalingrad during World War II was the largest battle in history. It lasted almost half a year and saw more casualties than the total military debt of the US, Great Britain, Italy, France, and Yugoslavia combined. In 1942, a unit of 104 German tanks were stationed outside of the city in reserve. But when they were needed most, its officers were shocked to discover that only 20 of their tanks were operational. Engineers investigated and soon discovered that during the weeks the tanks spent unused, field mice had nested inside of them and eaten the wires and insulation of the electrical system the tanks needed to run their engines. These tanks were not poorly designed, but no engineer would think to plan for a 20-gram field mouse to disable a 25-ton steel machine. It wasn't the engineer's responsibility to plan for freak events like field mice. It was the commander's responsibility to plan for a scenario where the tanks couldn't be used. Even when an investor thinks they've planned for every possibility, they haven't. That's why it is so essential that margin for error is built into every plan and strategy. Investors always need to account for the ever-present reality of risk in their investments. They should never bet everything on a single strategy. They should always maintain a reserve in case their investments go wrong. They should always be aware that the returns they expect may never materialize. Loss will always come eventually. Risk will always appear. The job of a competent investor is to make sure that when this happens, it's not catastrophic. To avoid these fates, investors should 1. Prioritize being financially unbreakable over bigger returns, 2. Build the possible and likely failure of any plan into your plans, and 3. Develop a psychology that is optimistic yet paranoid. For more insights from The Psychology of Money by Morgan Housel, check out the link in the description. Thank you so much for watching. And if you like this video, you can gain more business frameworks and book summaries from our library. Just check out the link in the description for more.